guys, welcome to Talking Money with Nozi, personal finance made simple. Today I want to talk to you about how much money you should be investing because people ask me this question all the time. First of all, let me talk about the difference between saving and investing. Many people think that saving and investing are the same thing. They are not the same thing. So what is saving? Saving is when you put money aside for use in the immediate future. In other words, saving money is putting away money that you will use soon. For example, we save for December holidays, we save for birthday presents, we save for a deposit for a house, we save for emergencies. The most common place where people put their money for their savings goals is in a savings account with a bank, and you earn a little bit of interest, but most importantly, you can withdraw your money anytime without the risk of losing your money without any penalties. I repeat, savings accounts are an excellent place to put your money that you will need soon. The reason why I am repeating this is because people expect miracles from savings accounts. They want their money to grow and give them huge returns while the money is sitting in a savings account. But that's not how savings accounts work. Here's the thing that you should understand about money. Low risk, low return. High risk, high return. A savings account is low risk. This means that the returns that you can expect are also low. You can't take low risks and then expect high returns. It simply doesn't work. If you want high returns, then you need to invest. So what is investing? Investing is different from saving. It involves buying and owning assets that either give you a regular income or grow in value over time, and you can sell them later for a higher price, or a combination of both these features. But the key thing with investing is that they have to do with ownership. Examples of investments are things like shares, unit trusts, exchange traded funds, rental property, or running your own business. Investments take a long time to grow, and you only invest money that you will need after a very long time, like 6 years, 10 years, 15 years, 20 years, or even more. For example, we invest in order to afford our retirement. We invest in order to pay for our young children's university education in the future. We invest to become financially free in the future. A key feature about investing is that it has the potential of giving you high returns, but they are also very risky. Let me give you an example of the risks of investing. If you buy a rental property, for example, the risks are that your property could stay empty for a very long time with no rental income coming in, or your tenants could stop paying rent and refuse to leave your property, or people can come and build shacks right next to your property and bring the value of your property down so that you can't sell it for more than what you bought it for, and you could also be forced to lower your rent because now the area value goes down and people really do not want to pay high rent in a low value area. Another example of risk is if you buy shares and the stock market crashes just before you need your money. For example, last year in March 2020, at the beginning of COVID, the world stock markets crashed and the value of most shares went down in value. If you needed money in March 2020 and you had sold your shares, you would have lost a lot of money. So because of these high risks involved with investing, it means you need to, number one, diversify your investments. Diversifying means buying different kinds of investments so that if something bad happens to one investment, you've got another one as a backup or other ones as backups. Number two, you need to hold your investments for a very long time. The longer you hold on to your investments, the more time they have to grow and to recover from any disturbances or any crashes. Investing is not suitable for money that you need in a very short space of time. I repeat, investing is not suitable for money that you need in a short space of time because that would be gambling. And when you gamble, the chances are very high that you would lose. Before you dive straight into saving and investing your money, you need to know your goals. Your goals are the reason why you are investing, why you are saving. Let's say you need to put away money for December holidays. How far is that goal? It's 3 months away. This is a short timeline, so you should save your money. Let's say you need to put away money for a house deposit for a house that you want to buy in 2022. How far is that goal? 1 year. This is also a short time frame, and you should save that money. Let's say you need to put away money for your child's university fees. How far is that goal? Let's say it's 15 years from now. That's a long time frame, so you should invest your money. Let's say you want to have enough money to retire comfortably in 20 years' time. This is also a long time frame, and you should invest your money. I hope you get it. Your time frame determines whether you should save or whether you should invest. Some of you are investing when in fact you should be saving. And too many of you are saving when in fact you should be investing. You need to write all your goals down, as well as how long it's going to take you. If your timeline is short, you save. If your timeline is long, you invest. Now, back to the question of how much you should be investing. For you to know how much you should be investing every month, first you need to know how much money you need at the end, and then work backwards. Let's say you want to invest money so that one day you can stop working and just survive from the income from your investments. For that, we use the rule of 300. The rule of 300 is a rule that is used by financial planners all over the world. And this rule says in order for you to retire comfortably or to stop depending on a job, you need to take your monthly expenses and multiply by 300. The answer that you get is the amount of money that you need to have invested for you to stop working. Let's say your expenses are 10,000 Rand per month. Using the rule of 300, you take your monthly expenses, which is 10,000 Rand, multiply that by 300, you get 3 million Rand. This is the amount of money that you need to have invested for you to stop working. The next thing that you want to do is to figure out the average return of the investments that you are interested in. So luckily, the returns for investments like rental property and the stock market are measured in terms of averages, and these averages are published on the internet, so the information is there already. I will speak about the stock market because this is my area of interest. The performance of stock markets all over the world is measured by using indexes. What is an index? An index is a way of measuring the performance of a list or a group of companies that are on the stock market. In South Africa, one of the popular indexes is the Top 40 index. This measures the performance of South Africa's 40 largest companies that are on the stock market. This index gives an indication of how the stock market is performing. In this picture, I highlighted 3 exchange-traded funds that track the Top 40 index. And over the past 10 years, the South African stock market has returned 11% annually. The most popular index in the world is the S&P 500 index. This index measures the performance of America's 500 largest companies and gives an indication of how the American stock market is performing. This index has been measured since 1926, and according to this index, the American stock market has returned 10 to 11% on average. The next question is, will the South African and American stock markets give 11% and 10% returns in the future? Nobody knows, but we can use these past returns to estimate future returns. If you are in doubt and you think that the market returns will be lower than what they were in the past, you can use a lower percentage for your calculations. I am going to use 10% for simplicity for this video. Okay, so what you need to do is to go online onto the compound interest calculator. Don't worry, I'll leave the link below in my description for this website. Okay, so please don't worry about the currency. The calculations work regardless of the currency. So this is what you see. Currency is in dollars. I'll leave it like that. It doesn't matter. Initial balance, interest rate, that's where you put in the interest rate. years, that's when you put in the years, and then you choose your compounding interval, and then you also choose your deposits. So let's go back to the top where it says initial balance. Let's say you're starting from 0. Let's say you've got no investments. You put 0. If you do have investments, put the balance there. Interest rates, I'm just going to use 10%. Okay. Number of years, let me put 50. Don't stress about this. It's just so that I can see the calculation running. I don't want to come back and edit the years. And then where it says compound interval, usually compounding is annual. Okay, so yearly, choose yearly. And then the deposits. How much are you going to be depositing into your investments every month? So let's say 1,000. Let's start with 1,000 Rand. Then now we calculate and say, and see what it gives us. Okay. All right. So it gives us the future value for 50 years. This is not what I'm interested in at the moment. I just want to see the yearly breakdown. This is what I'm interested in. So I want to see what the balance is for every year. So you can see with year 1, the balance would be 12,550. Okay. But I want to see at which year the investments get to 3 million. So you keep on scrolling until there. So what it means is that if you invest 1,000 Rand per month for 34 years, you're going to reach 3 million. So what if we change the investment, the monthly investment amount? Let's go back and put in, let's say, 2,000 Rand. And let's calculate that. Okay, we're going to scroll down again and see this time at which year we reach 3 million. Okay, so there's our 3 million. We reach that after 27 years. So if you invest 2,000 Rand per month, you will reach 3 million around 27 years. Let's go back and change our monthly investment to 3,000 Rand and calculate that. We scroll again till we reach where it says 3 million. There we go. So if you invest 3,000 Rand per month at 10% annual growth, you will reach 3 million after 24 years. So I hope you can start seeing the pattern. The more you invest, the shorter your investment period becomes to reach your target, right? So if you invest little money, it'll take you longer to reach your target. Let's go back and put our last amount. I'm going to put 4,500, for example. Then calculate. Let's see. There we go. So if you invest 4,500 Rand every month for 20 years, you will reach 3 million. So this is how you use the compound interest calculator to estimate how much you need to be investing. And like I said, those returns are average returns. It doesn't mean that the stock market will always give you 10%. It can give you more or it can give you less, but this helps you with planning. If you think that the stock market is really going down, it's not going to give you 10% returns in the future, what that means is that you need to invest much more. But if you're optimistic, you're thinking, hey, the stock market is going to do great, it's going to give us more than 10%, it means you're going to invest less. But I'd rather be cautious and assume that the market is going to give less, rather than to assume it's going to give more and underinvest. That's it, guys. That's how you estimate how much you should be investing every month to reach your long-term goals. Simple, isn't it? If you want to learn how to set your different goals and how to save or invest for each goal, you can buy my ebooks that explain how to do just that. Please see the description below for my contact details. I hope you enjoyed this video. If you have any comments or questions, please write them in the comment section below. Please also remember to subscribe to my channel for more content. Thanks for watching. Bye, guys.